Hello, everyone. Welcome to SPAC Chat. I'm Karen Snow, head of U.S. listings here at Nasdaq, and it's my great pleasure to be speaking with Alex Slusky, founder, managing director, and CIO of Vector Capital, and chairman and CEO of Vector Capital series of SPACs. Vector has launched two SPACs on Nasdaq, the first of which successfully merged with Rocket Lab, a renowned American space manufacturer and satellite launch service that is partnered with NASA. Alex, congratulations. It's great to have you here with us today.
Thanks, Karen. Happy to be here.
Wonderful. Well, why don't we start off by having you tell us a little bit about your background and what makes Vector's SPAC strategy so different?
Well, Vector has been an experienced investor in the technology space for over 20 years. Our initial business was to run a private equity firm that's focused on technology companies, software, communications, industrial technology, digital media. So this is not a space that's new for us. In our SPAC effort, we're focusing on exactly the same kinds of companies, but ones that are more appropriately owned by the public market rather than the private market.
So that's fantastic. Now, when you're focusing on targets, what are you looking for when you evaluate a target? And from your perspective, what's the most important thing to get right?
Well, the most important overarching theme is for a company to be public market ready. Now, that's a sine qua non of any kind of SPAC pursuit. Underneath that, what does it actually mean? It means the company must have truly differentiated technology, which enables its customers to benefit from its services, but also builds a bit of a moat around the competitive space. It needs to have revenue that is ramping, consistent with what you'd expect a public company to do. It needs to have some level of predictability, so you can begin to guide Wall Street with respect to what will the next quarter look like, what will the next year look like. Businesses that have struggled in the public markets are ones which are not mature enough to have that kind of visibility. And last but not least, it needs to have a very compelling management team. Having a management team that has experience, that understands its space really well, and can be appropriate stewards of shareholder value are very important factors. And you really need to have all of these things come together to have the optimal kind of SPAC offering, and frankly, an optimal public company of any kind.
Yeah, it's very true. So can you share what made Rocket Lab so successful and what in that transaction, and maybe share a little bit about the shareholder ownership structure as well?
Sure. Well, Rocket Lab had many, if actually all of those factors. In terms of its history, it is really the only other proven provider of space launch, other than, of course, SpaceX. And while SpaceX is clearly number one, Rocket Lab is also clearly number two. We have over 20 successful launches completed with over 100 satellites placed into orbit, whereas the next largest competitor has one. So there's a very wide gap and a very wide moat between what Rocket Lab is able to accomplish today and a lot of its competitors in space launch business. Rocket Lab also has real revenue. I can't comment on specific numbers because we're now public, but as you can look at analyst reports and as well as our quarterly reports, the company is genuinely ramping, and it's not a concept play. It's a company where you will see growing revenue and growing success in a very proven manner. And company also has a highly compelling founder. Pete Beck is unlike most entrepreneurs I've ever met. In fact, Pete hails from New Zealand. And when he was growing up as a kid in New Zealand, he dreamed of rockets. And there's actually a wonderful vignette where his guidance counselor from high school takes his parents aside and saying, you really need to explain to Pete that New Zealand doesn't have a rocket industry. And if he wants to be able to support himself and his family, he better come up with a different pursuit. Well, guess what? A couple decades later, Pete built New Zealand's rocket industry. And in fairness, the company is actually based in both New Zealand and the United States. But we launch primarily from the Maya Peninsula in New Zealand, and a lot of our operations are based in Auckland. And so Pete pretty much single-handedly put New Zealand on the map when it comes to aerospace. And it takes a very special entrepreneur. The other thing that he accomplished that was extraordinarily impressive is, prior to going public, Rocket Lab only consumed around $200 million of capital, which might sound like a great deal, but in the rocket business, that's nothing. That's something the government spends in a blink of an eye. And he was able to build an entire rocket program for that. So the company has also been very, very thoughtful with its capital expenditures. So when you have a combination of tremendous track record, financial visibility, competitive advantage, a tremendous entrepreneur, it made it kind of a compelling proposition for us to partner with. And we were very fortunate to be partners with Pete and his team.
As you know, some companies may be dual tracking between a SPAC and a traditional IPO. What would you say are the benefits to going the SPAC route?
Well, companies should consider both paths because they're both legitimate ways to get to the public market. But the SPAC route has some significant advantages. One, it is more predictable. You actually negotiate the valuation of the company with the SPAC sponsor, as well as typically with large institutional investors that participate in the pipe. So you have a lot of predictability. You don't have this kind of uncertain approach where you're going on a roadshow and investment banks make promises, but they really can't deliver those without the buy side buying into. So you might have a valuation that skyrockets after the IPO. Obviously, people are hoping for that, but that also means shareholders left a lot of money on the table. Or you could have a situation where you struggle and you have negative momentum and you have to, in the public eye, cut your valuation, which creates a lot of negative perceptions for what may actually be a good company, which the investment banks have actually mispriced, which happens. So I think the SPAC world is far more predictable. It is also a little bit faster. I think the process for organizing a SPAC IPO, we should call it, is a little bit faster than a traditional IPO. And finally, at least for now, there's an ability to share long-term projections, which the IPO regulatory regime doesn't currently allow. So for companies that are growing very fast and can point to the future with confidence, again, the SPAC approach could be more appropriate. So it really has to create, you really need to have all these factors come together and make sure that they're important to the business, but both are legitimate ways to go public. And for the right opportunities, one may be better than the other.
Yeah, that's super helpful. So the $1 million question, or maybe I should say the multi-million dollar question, how do you see the SPAC market playing out in 2022?
More rationally. What we saw in the first quarter, maybe the first half of last year, was a lot of companies going public that had no business going public through SPAC or otherwise. And so you've seen some disappointments with share prices being below $10, which obviously causes investors to lose money, and having companies miss their numbers. So it was never supposed to be that easy to have a company use the SPAC route to market. Because as we just discussed earlier, it still needs to be public ready. And that lens seemed to have been removed for the first few months of last year. And now we're seeing a more normal market where going public is hard. It's supposed to be hard. Not every company is supposed to be able to have public shareholders and have all these factors play to its advantage. So SPAC sponsors have to be more discerning. They have to put more of their own capital to work, just like as we did at Rocket Lab. Vector committed $50 million from its balance sheet to the pipe. I think that's an important distinction. And you need to partner with firms that have a history of making money in the private and the public markets. Firms like ours, which are able to bring value creation efforts. We have a 20-person operating team that helps our portfolio companies in addition to the investment team. So for us, just another way to partner with a company of quality. And for the market, I think you will see experienced repeat sponsors be successful. And sometimes just having a few entrepreneurs who got together who've never really operated in investment space, I think some of those SPACs are going to continue to struggle.
Very insightful, thank you. So before we sign off, any final words of wisdom?
Well, I certainly hope that 2022 brings better tidings to all of us. I'm very optimistic to where the technology space is headed. and for what's going to happen in the SPAC market and elsewhere. So just want to wish your viewers a very happy 2022.
Alex, thank you so much for your time. And on behalf of everyone at NASDAQ, we wish you continued success. And that's it for SPAC Chat. See you next time.